Hello, I am Robert and welcome to my channel where I talk about everything algo trading, automated algorithmic trading, however you want to put it. And today I'm going to go through and talk about all of the shorts I've been putting up on YouTube lately and the bot I've been using. Now I've rebuilt this bot over the last week to be far more efficient than it was. I'm not going to get into the code today because I want to talk about the theory, which is going to be quite a bit complicated as it is. Mixing the two, I think, would simply make the video more cumbersome than what it needs. So for now, we're just going to talk about the theory of what this bot is doing and why it is so significant. Okay, as I've mentioned in my shorts, I am using a counter trading strategy. What that really means is that when the market is going up, I am opening long positions, and when the market is going down, I am opening short positions. I'm actually trading opposite of what I should be. If the market is climbing, I should be going against that climb, meaning I should be buying low, selling high. But what I am doing is just the opposite. As the market climbs, I buy more, so that once the market starts dropping, that's when I sell. Now that's a counterintuitive process, but it is a successful process if you understand the risk. And that's the bot I've built and I'm testing and will soon have up on GitHub for you to be able to download and use with your relay system. So for now, let's actually go through what we have on the screen. And I've actually got a trade here where I can demonstrate exactly what happened. So first of all, because I've done one bot to trade multiple assets or multiple pairs, I'm actually tracking how long each pair took. In this case, 97 hundredths of a second for Euro USD opening or checking a short position. Now right now I have 33 positions open, and the spread by which I bought my last position is 1.3 pips. I'm running this aggressively so I don't have a margin restrictor or a units restrictor, and I'll get into those two in a little bit with one below. But here is my current spread of 1.5 pips if I were to sell it. So basically, as I described in an earlier video, my absolute profit is 5 pips, but I take into account what I paid for my buying spread and what I have to pay for my selling spread. So in this case, 1.3 pips and 1.5 pips is 2.7 pips that the market has to move just to make sure I cover the spread of the market. Now I add in the 5 pips that I want for profit, and that means this market has to move 7 pips for me to either buy or sell based upon where the price is actually at. Now that's something that you'll see is missing from this line. I don't display the price except when the transaction actually takes place. And in this case, I'm selling at 16.45 for 46 units, which we'll cover the rest of this in a minute. But this is the current balance of the account. Now the thing with this particular bot and the methodology that I'm using, balance isn't that important. All that matters with your balance is that it needs to be above your margin limit. That is the really only major critical point you need to focus on. And that's where the genius of this bot really begins to shine. Because here I have the amount of margin in use. I've actually know exactly how much margin of my account I have used, and I have a very specific margin limit. That is 20% of my balance. So whatever my balance is, 20% of it is how much this asset is allowed to use. No more. Right now, I am roughly 1/3 of what I allow. So I have $12 of actual margin used. I can use up to $39. And if you look at these numbers, you'll see they change. And that's the beauty of it. As this bot buys and sells, each time it reevaluates the asset, in this case Euro USD, it figures out what its new limits are and dynamically adjusts right then and there. So as you can see here, 46 units, my balance again, and the margin. And this line pertains to the line below it. So this price is reflective of the Hong Kong dollar yen trade. And you can see by monitoring the balance over time how much it changes and reflects within the trade. For example, 730 to 97. So basically this trade gains me roughly 15 pips, which is really quite nice. But you see, I have the margin limit or the margin pips where I take the amount of margin I'm using, which in this case is roughly $8.3, and I convert it into pips. So I have to move an additional 8 pips either to buy or sell. So for this particular coin, or excuse me, this particular Forex pair, if you watched this morning's video, you saw where the market was just insanely volatile. Well, this type of a risk mitigation approach brings that down drastically. And I have taken into account the number of units that I have, as well as a unit pip or a unit limiter, which basically means that this market has to move an additional 47 pips for buying and selling. So we have 47 pips, 8 pips, 21 pips, and 20 pips, all added together as the spacing between the buys and the sells appropriate to the price itself. That really is the critical part of what keeps this entire process on track and from blowing up. But even with those kind of limits, you can see my margin used actually went over my allowed amount. Now, because I planned for extras just in case as part of my natural risk assessment, I'm only using 5% of my balance here, which means I have no more than 45% actually in use. But because of this type of dynamic, I am able to control my risk, and the Labat will simply wait until it has an opportunity to sell. So as it continues and as it develops over time, it completely grows and compensates with the market for me. So let's bring this back up and running. And the beauty about this bot is it is able to figure out what it's doing automatically. It figures it out, it takes care of it, it does everything, and it puts itself back on track. And that's really what makes this type of a system so wonderful to work with. It's resilient against just about any kind of market situation. And as you can see, I have $12, $20, roughly $24 maximum margin out of my entire budget. And my entire budget is $159. So that shows just how little I'm really using compared to how much I have, and just how well the risk management process is working in controlling this entire system. But this is not just the end of the story. If you've been following my Patreon, and I will leave those links in the description, I've talked about scaling this process, and I've talked about how to deal with worst case scenario. But I got that information specifically from a demo bot or from a paper trading bot, where I've set it up to mimic the market as much as possible, but with every single pair. My exchange gives me 65 Forex pairs to trade. So that's what this is doing, is it's trading all 65 pairs. Now you see the amount of time each pair takes. And the beauty about this bot, which really makes it simplistic in nature, it's price action only. So I don't have to worry about how long it takes it to complete one cycle. In this case, you're looking at roughly a minute to 2 minutes based upon whatever my VPS is doing. And that's fine. You can see here 3 seconds, 1 second, 3 seconds. It doesn't matter. The bot completely figures everything out internally. All of the risk management systems are really where things shine. Okay, now let's look at the balance. You see I got some kind of a crazy number here that's really pointless to the point of what I'm actually looking. It doesn't matter as long as it's simply greater than the margin I am using. So I've set this bot up in that if I wanted to take half my balance and apply it to one single asset, how would that perform? So you have the number of positions that I have open, the spread by which I bought it at, the number of pips. And in this case, you can see this one is insane because the pips of purchase is 3,800. Now I'm running this aggressively, so these numbers are going to be 0, but then my current selling pip is 3,600. And you see how much I have in my current margin used and how much my maximum margin is. So I'm only using 10% of my margin in this case. But let's go look at something that just went totally the wrong way and, well, broke the system. Here it is, $103, and my limit is 100. Now, because I'm expecting to go only around 45% maximum margin, this is exactly why I did that. Because I know there's going to be a little bit of overage just by the way the market works. So by staying at 45%, there's very little chance I'm ever going to deal with the margin call. I've given myself enough breathing room for this asset to correct and recover without blowing my account up. So that's really where you want to focus and how you want to focus your trading. The very first thing you want to take into account is always risk. Think about your risk in correlation with your budget. Even with, like, my real account, 159 total dollars of balance, and yet I'm only allowing $39 of it to be used for one particular asset. Now this is my short bot in order to test and counter test against opposite direction. I also have a long bot, and I deliberately did not start them at the same time, because the way this counter strategy works is they will normalize on their own over time to be opposites of each other just by the way the market naturally moves. Again, that's built into the thinking process of the bot, and that's how you really achieve the best strategy approach for mitigating your risk and for protecting your balance as much as possible. And again, you'll see the balance of my margin used versus what my limitations are, and then of course the meaninglessness of the budget itself. But you see how the budget changes over time, where I'm actually picking up profit, in this case a 3 cents profit. Now, referring to the Patreon article of scaling, that's going to be the most difficult part of this process. How do I scale it without blowing up my account? I've got $200. Well, if I do 1% of my balance, that's roughly $2 of margin. I have 65 coins. 65 times 2, I've blown my account. That basically is over 120%. But if I do 1% of my margin, that gives me $1. Not going to get me very far, but I could trade every single asset on $1 and only use 65% of my account. Actually a little less, but still functional, safe, reliable, and protected. Now, more specifically, if you're looking to take out some of the higher risk assets, anything from the Asian sector can probably be left off the list, and it will make your trading a little less volatile and a little less expensive. But that is exactly the purpose of what this bot is meant to demonstrate. Exactly what pairs will be the easiest to trade and the most difficult to trade in both a short market and a long market. This is the whole point of what you need to do when you first think about scaling. You need to test. You need to analyze. You need to collect your data. And you need to keep your margin assessment realistic with what you plan to actually really trade with. So my intention, $100 per asset. What assets are going to likely be the best use of my resources? That's going to be the assets that over the course of time use the least amount of margin. Whereas assets that use the most amount of margin and end up hitting my margin limit are likely going to be assets that I want to wait on until I get a better budget, which basically depositing $20 every month is going to help over time build that budget, or depositing whatever you can afford. So from the process of the bot, the counterintuitive process of trading really is an interesting approach. And the best way to think about it, let's take, for example, opening a short position when the market is going long. That is suicide by most situations. You're deliberately shorting a long market. What you're doing is basically the boat anchor effect. Every time you open a trade, it's 1 unit more than your previous trade. Over time, you're adding resistance into the order book. And because you're not the only person doing this, the combined weight of all of the traders doing the same thing is going to slow the momentum of the market down to the point that price reverses and you can begin taking profit. Now, on the long side of it, it's exactly the same principle. You are simply deliberately trying to go against the market to add enough weight between you and other traders to reverse the price. And that is how you get your profit. You profit from the point of reversal. The stronger the reversal, the more profit you earn. But the counterintuitiveness is that you need to build slowly that resistance in the direction the market is going. So if price is climbing, you want to accumulate short position on the order book to register and show that the market momentum is decreasing. If the price is decreasing, you want to register orders on the order book to show that there is strength for the market to climb. So you want to help push the market in the opposite direction it is going. You want to counter the market deliberately. Now the risk is that the market could just keep on going and drag you with it. And that's what happened when you saw my one position right here. For example, my margin used exceeded my limit, so the bot shut down. In this case, the market kept going against my position. So now this is nothing more than an anchor waiting for the market to correct and come back into my direction. But it is still an anchor on the order book that is affecting the orders by slowing down the momentum of the market, not by itself, but through the combination and combined efforts of thousands of traders all thinking the same way, that the market needs to be corrected and that by adding resistance to its continued climbing price, it will eventually correct and profits will eventually be taken. But because the bot is simply sitting here and not purchasing, I've made sure I have more than enough balance in my account to accumulate and wait out the duration. This is how you protect yourself long term because you simply can't predict where the market is going. You think about totality of your account by making sure I never exceed 45% of my total account balance throughout all of my trades. I never have to worry about the risk of being overextended. I just have to watch the market and make sure no one particular asset gets so far out of control that it won't recover. And by adding budget once a month, I am increasing my limits over time slowly and consistently, such that even if an asset does blow up and go outside my margin limit, when I add that budget, that's going to affect my margin limit, and that will help put me back in the market, thus continuing the path of slowly building the resistance to help push the price into reversal. So as you watch this technique and you see how it works, it's not complicated, and you can even do it by hand. It's actually an interesting technique when you really study it because of the way it works and because of the intuitiveness of how it works to balance within the market itself. It can be confusing at first, but if you focus on just one single pair and you really begin to watch the chart, like what I've demonstrated in the short videos over the last week, the process really begins to make sense in just how it makes profit and why it needs to have so much saturation to be profitable. That buildup of the market pressure is how it actually succeeds in contributing to the reversal of the price to the point that it takes profits in a meaningful way. Scaling the process takes place on two levels. Either one, your initial entry point or the number of units, or 2, the number of units you add to each purchase as you accumulate. The bot defaults to 1 unit at the first purchase and adds only 1 unit each consecutive, but you can change both of those numbers such that you could start out at 10 units and add 5 units each consecutive purchase. Now that will affect your margin, and that will affect your margin limit, which is why you want to test this out thoroughly to get an idea of your worst case scenario planning and the limit that is going to have on your account if you accumulate too much too quick. That really is one of the biggest and most scariest part of this entire process, is really scaling it without blowing up your account. In this case, on my live account, I have $159 in balance. I have a hard limit of 45% of it in use. So as I slowly deposit money into this account, that 45% is going to change, and my account is going to grow and shrink appropriate to the balance as it grows and shrinks from actual trade. By focusing on your risks in such a way, you are all but guaranteed profit, even on a bot that has no bounds and no limit and can pretty much follow the market anywhere and everywhere. Now that has some very serious risks. Paper trading is the only way to understand those risks. But once you do understand them and you find the right asset that really pertains to your style of trading or to your own interest, in my case, based upon my weight, you can see that is Euro USD. That fits my particular level of volatility and aggressiveness that I want to trade long term. And that really brings us to the final point of this video. How long should you trade? Or more specifically, how long should you have in your mind that you will need to trade in order to make a profit? Grid trading is in of itself a interestingly challenging process because you need to consider a minimum of 1 year to truly be profitable in a given forex pair, cryptocurrency, or stock. When using a grid trading process, you need 1 full year of trading to really gain a good realized profit. And that may seem like a strange commitment and why you would even want to trade an asset that long. But that really is exactly the whole point of the process. It can dynamically adjust and change to the market no matter what the market is doing, because it is simply following the price. The consequence of never worrying about what the market is doing is that you have to have patience and let the process work out over time. Let it normalize through the process of longs and shorts and determine where the market wants to sit and rest, which in and of itself will change over time as well. Basically, a grid bot of this nature is following the market and profiting using the path of least resistance. By having 2 sub-accounts, one long, one short, you're profiting in both directions, and you're simply letting the market determine where its own balance is. Now the next video will probably be talking about the source code itself and how that source code really evolved into what it is now compared to what it was. But having the theory down and understanding how this really works will make understanding the source code a breeze. And it will begin to really show and tie in the learning Python part with the Jackrabbit Relay, because you will begin to see real world trading mechanics, not just in theory, but in real practice, like what you see on the screen. Live trading, the whole point of what algorithmic trading is from beginning to end. The actual process of making money. So be sure to check out the Patreon article, as they provide a wealth of additional information in explaining this process and some of behind the scenes information necessary for understanding. If you've enjoyed this video, please like it, subscribe, and ring that notification bell. It really does help get this content out to more people that want to learn how to be responsible for their own finances on how to actually take the next step and write their own bot. Thank you for watching, and until next time.